What's going on, guys? Welcome back to another video. So in this one, we're going to be going over the craziness that we have in store for us for the rest of the market this week. We have some crazy things happening next week. We have these hedge funds getting liquidated. We have a lot of new home buyers also underwater on their mortgage, which tells us a lot about where we are in terms of this Fed tightening cycle, where we could see things go in the future, and just how important the economic data points that are coming out right now actually are in terms of how the overall market is going to fare in the rest of 2022 and early 2023. So we have a lot of information to cover in this update here, guys. And again, as always, before we get into all of that information, make sure you guys go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who actually want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So let's get right into it over here. I know that all you guys in 1348 were absolutely printing today. There was a lot of money to be made, especially with Gabe's bold SPY prediction earlier this morning. But looking at what happened right now on the SPY on the daily time frame, there's about 20 minutes until close. Not a whole lot has happened here on this daily time frame. Yes, you have rallied off a little bit of these lows here, the more recent lows that we've seen, but we can't get above that 13 EMA on the daily. We haven't quite cracked down below the 48 EMA on the daily, and this sets us up for some potential aggressive volatility tomorrow after PPI, the producer price index data, comes out tomorrow in the pre-market. Now, looking at SPY on the 4-hour time frame here, again, what we like to call this right now is rimming. So you could end up seeing the SPY come down to this 200 EMA on this 4-hour here, right around 390.26. That is very possible as well. If you break above this 48 EMA on the 4-hour, there is some potential to rally back towards these highs at around 410. You can also see that the MACD on the 4-hour is losing that bearish momentum. The RSI is crossing above its moving average, trying to get above 50. But again, like we always say, when you go into a period where there's going to be a lot of economic data coming out, it's very similar to earnings. It's just a coin flip. So try not to go out and front run the data or try and predict anything or risk too much money on any of those risky bets that you may be taking. We're going to see where the market wants to go after the data comes out, and we'll react accordingly. Now, when you look at the dollar over here and throw this on the daily time frame, again, you are still seeing it respect that 200 EMA and walk its way down here. Now, typically, with these larger moves down in the dollar, you would expect to see the overall market be up a little bit more. Well, we're seeing the SPY up about 0.7% on the day, with the dollar down about 0.36. And remember, we have rallied pretty significantly off of the lows in the overall market here. Same thing with the 10-year treasury. And again, this is really a good indication of just how risk on or risk off investors want to be at the current time. As you guys can see, looking at the 10-year treasury yields on the daily, you can see that they've been slowly stepping down ever since the beginning of November here. What that means is that more money's flowing into the bond market, potentially out of the US equity market, but it's flowing into an asset class that is typically a lot less risky than the overall United States equity market. So that's a good indication right here of kind of things to come. If people are going to go more risk on, more risk off, the 10-year treasury yields are going to be a really good indication as to how aggressive these large money investors actually want to be. Now, I do want to talk a little bit about some of this housing data as well. And as you guys can see here, around 450,000 home buyers are now underwater as early FHA delinquencies hit 2009 levels. That's not the best thing that we want to be seeing right now, and it's definitely not going to help out, especially all these people who have recently bought homes. As the housing market continues to implode, marking a record drop in pending home sales last month amid canceled deals and price cuts, there are around 450,000 homebuyers who owe more on their house, owe more than their house is worth. As of the end of the third quarter, according to a new analysis from Black Knight, of those, around 60%, or 270,000, bought their homes in the first 9 months of 2022. In total, around 8% of mortgages taken out in 2022 are now marginally underwater, with another 20% having a low equity position. In short, there is little risk for those who bought more than a year ago, but 2022 home buyers haven't fared so well. Now, this makes complete sense. And again, this is a little bit of kind of a macroeconomic lesson here, that as these rates go up, the federal funds rate, it's going to increase mortgage rates as well, as we see all of these other bond yields go up and other things that these mortgage rates are going to be pegged to start to climb up. Now, when this happens, home prices go down because if you could previously qualify for X amount on a loan, well, with a higher interest payment or a higher rate, you're not going to be able to afford as expensive of a home. Now, what do people do? Well, they need a place to live, so then they go into the rental market. In this article right here showing that a lot of these home prices are coming down, which we already knew. Well, remember, in the last couple of CPI reports, we've seen rental inflation really start to pick up. So people are foregoing the opportunity to buy a home right now, and they're going into the rental market. More demand, less supply, prices are going to go up. So for the time being, it doesn't look like this is that aggressive of an issue, but it's definitely something to keep a lookout for, especially if you are looking at picking up some properties for long-term investing, or again, if you want to be a landlord. Now, I also want to talk about these hedge fund redemptions before we get into PPI and exactly what we have going on into tomorrow. So hedge funds have been hit with redemptions. Now, this came out December 6th of 2022, but hedge funds have outperformed public markets, but are now suffering from redemptions as investors find they are overweight alternatives. Hedge funds are experiencing high levels of redemptions from investors as their current allocations to alternatives stays well above their targets. Private equity is also suffering from the pressure of over-allocation. In North America, the average investor allocation to hedge funds stands at 15.2%, more than 3 percentage points over the average target allocation of 11.9%, according to a Preqin report published Tuesday. Investors in the Asia-Pacific region have allocated 11.2% of their assets to hedge funds, slightly higher than the average target of 9.4%. Now, as we come down a little bit further here, the ability of hedge funds to protect investor assets in 2022 is part of the reason investors are over allocated to the asset class. According to eVestment data, hedge funds lost an average of 7.6% year to date ending in October, while the S&P 500 lost 17.1%. The two most profitable strategies, managed futures and alternative risk premium, gained an average of 12.9% and 8.6%. So when you think about Sharpe ratios and alpha or outperforming the market here, a lot of these funds are actually doing very well, but they are still seeing a high level of these redemptions. And as we can see down here, Ben Crawford, head of research at Barclay Hedge, said that the deteriorating macroeconomic landscape has also contributed to the large withdrawals from hedge funds in recent months. There were ample reasons for investors to sour on risky assets. Now remember, this concept of going risk off. What have we seen with the 10-year Treasury yield, and what have we also seen starting to come out of the large banking institutions? They are very nervous about what's to come in 2023. So you're seeing people take their money out of the market, putting it into more or less risky asset classes or more safe asset classes. And they're also taking their money out of the market. I just believe I said that as well. So they're taking their money out, they're moving it into more or more safe places in the market here. That tells us a lot about what institutional money is actually doing, or large money investors. You've seen the narrative of the pivot, but when you see redemptions, bond yields starting to come down, that paints the actual picture of how investors actually feel about this market at this current time. Now, the last thing that I want to go over with you guys is the PPI data that's coming out tomorrow morning. So the PPI is the Producer Price Index, and for those of you guys that don't know, it's a measurement of the average change over time in the selling prices received by domestic producers for their output. These prices are included in the prices included in the PPI are from the first commercial transaction for many products and some services. So what you're essentially looking at here is a little precursor to the inflation data that's coming out next week. Now, when we look at what we have in terms of what the market's pricing in for the rate hike coming up next week as well, at the current time, we have about a 79.4% probability of a 50 basis point hike. Now, is that really a big deal? In my opinion, no. Going from 75 to 50 really makes no difference. And where am I getting that information from? Well, direct from Jerome Powell's mouth. What he has said is it's no longer a real big question of what the size of the rate hikes are going to be each time they do them, but it's the final destination of where we're actually going to go with rates. So to kind of wrap this up in a nice little bow here, we do have some inflation data coming out tomorrow, but we also have a lot of investor money going into less risky asset classes as we head into the end of the year and the beginning of 2023. And this coincides with a lot of these banking institutions signaling for a recession and saying that there's about a 25 to 35% probability that we're actually going to be getting a soft landing. So that is going to wrap up this video, guys. Make sure you guys protect yourselves out there in the market. Don't take on too much risk. Please please, please, please do not be taking on too much risk. Trade safe. Make sure you're taking those base hits. You only need 1% a day. Other than that, guys, if you wouldn't mind hitting the like button on the way out, subscribing if you want to see more videos like this. Other than that, peace.